you will you be able to identify it under fictitious accounts or manipulation of books of accounts as one category, and otherwise any other type of fraud, which is the last category that you see. Let me see if I am able to convert to a pointer here, so that I am able to point out on. Nikita, I think that only you can do, right? Since you are sharing the screen, I will not be able to use a pointer.
Actually, sir, may I ask any question?
Sorry.
Actually, I have some question. Can I ask?
Yeah, sure, please.
My question is that in IBC cases where the this POFA transaction is there in IBC, and you know, the 2.8 lakh crore evidence and a POFA application is filed to the adjudicating authority, but only 20,000 crore, 22, 20, 30,000 crore is also gonna rectified by the NCLT and take consideration. But you know, the measure of the part 2 lakh crore is not taken decision by the NCLT. So my question is, as per the evidence that there is in forensic audit, there is a lack of evidence, or there is any problem on that, why the NCLT is not able to take the decision, because 2 lakh crore is a very big amount. It is due to lack of evidence as per Evidence Act 1872, or any problem?
No, I think very good question, and that is the biggest trouble today. That RPs are facing and even lenders are facing. But the question which you asked also has the answer here, that a lot of times, even though you are able to classify and identify the transactions and then submit those to the adjudicating authority, but they lack evidence. They lack substantial documentation or supportings for adjudicating authority to take a call. That is one reason. Second reason is also around the entire bandwidth of adjudicating authority here, and which is why it is taking time. So it is not that the entire 200,000 crore which is pending for a judgment will get non-classified, just that it is taking a lot of time also. So there are both the reasons here, and we will, as part of the presentation, we will cover a few things that we have to be careful about while performing forensic audit or transaction audit. And if you are careful about these things, at least your submissions can be more robust when you put them to adjudicating authority. So we can move ahead, Nikita.
Yes, sir, you can please.
Yeah, we can move to the next slide. Now, it is also understand to see who is a willful defaulter here. And the key question is willingness versus ability. This is more applicable for lenders to qualify a borrower as a willful defaulter, but it is very important for RPs also to understand this, because you need to know whom are we dealing with when you are driving a process of a particular borrower's IBC process. You need to understand what kind of a borrower we are dealing with, right? And which is where the definition of willful defaulter is very important. And these are some of the elements that RBI has clearly mentioned as to qualify for somebody as a willful defaulter. And if you see the last line in this definition is fraudulent transaction by the borrower. So if you identify any kind of a fraudulent transaction by the borrower that you are dealing with, you know that you are dealing with a willful defaulter, whether classified until the time you are put into the position or later on classified is a different question. But in your mind, you will have to make a decision at an early stage on what kind of a borrower that we are dealing with. Accordingly, you may have to take a little liberal or a little aggressive stand in terms of certain actions that you have to take as an RP. Let's move to the next slide, please. Now, diversion of funds and siphoning of funds. Again, this is very, very important to understand, because when you see the entire fund flow for your relevant period of the entire time where the borrower has used the borrowed money, we need to understand are there any transactions which are diverted, or are there any indications that the funds have been taken away. I will not go into details of line item here, but broadly, if you see, diversion means you are using money for any other activity that it was, other than the ones which it was taken for. Again, you will face limitations here a lot of times, because lenders have also, disbursed funds without very, very specific details of how the utilization has to happen, and in which case it becomes difficult to comment whether it is diversion or not, and which is where you have to go a little one level above and see whether you may want to call it diversion or not, and where you have to see form over substance. Now, even if the reason in the disbursement is not very clear, black and white, but if you understand the submissions before the disbursements were made by the bank, the submissions for disbursement of funds, there are a lot of times the lender or the borrowers have submitted with reasons and with intention of utilization, whether it is for OPEX, whether it is for CAPEX, whether it is project finance, whether it is a particular type of a loan, that needs to be determined from the submissions that have been made prior to the disbursement. And then accordingly, the utilization has to be seen or verified to understand whether there is diversion that has happened or not. And siphoning off is very simple, where the funds have been taken away by the borrower. As I mean, the promoter has taken away the money and used it into any other entity or for any other personal purposes or anything else, that has to be classified under siphoning. Now, so I just wanted to cover some of the broad elements before getting into the details. Now we'll try to understand what is forensic audit and what do you look and how do you look and what are the challenges, etc. So here, let's look at some of the key challenges that we face, or as a forensic auditor, or which RP will face as the authority in question, and then what are some of the mitigating measures that you may put in place to avoid these. There are certain challenges before transaction audit which I've categorized as pre-transaction audit. Key challenge: it is a time-consuming activity, but you have specific timelines to adhere to when it comes to forensic audit. It can be an expensive affair depending on the operations, the period that you want to cover, the other challenges in terms of availability of documents, non-availability of documents, availability of previous employees, etc., etc. So it can be a time-consuming and expensive effort to do a forensic audit. The problem here is it is expensive to do a quality forensic audit. It can be relatively cheaper and inexpensive if you are doing a tick in the box exercise. We have seen a lot of malpractices also in the industry where people are getting a forensic audit done at a very, very cheap rate. People are ready to do it also, but then when you see at the output, there is it's kind of not up to the mark, which is the requirement under IBC, or which is the entire genesis of the process. Second is prioritization of forensic audit. See, I understand as soon as you get into the roles of an RP, there are tons of compliance responsibilities and duties that come on your head. And obviously the RP becomes very, very busy in resolving all those issues. And that's why the priority which forensic audit should get is generally not given to it. The problem here is if you don't give priority to it and some time already passes, on the back end, what happens is a lot of evidences, transactions, history gets deleted in terms of ERP system getting crashed, the server getting crashed, assets being destroyed, assets being stolen, documentation being stolen or destroyed, etc., etc. People move into different roles and then they are difficult to get hold of. So the more time has passed before starting of forensic audit from the time of the company getting admitted into the IBC, the less likely is the chance of you to get substantial documentation and evidences for transactions that you may apply to the adjudicating authority. And this is precisely the point I was also saying as a response to the question that came in. So you need to have forensic audit or transaction audit prioritized as soon as you become an RP. I'm not saying that you have to immediately appoint the forensic auditor and start getting it done, but that activity of forensic audit should be on your mind as a priority, so that you take active efforts in preserving evidences, in preserving assets of the company, which may be useful later on when the forensic audit happens. There are incomplete financial statements at the time of the audit.
Sir, one question.
Yes, please.
Sir, I would request, can you please cover that in the Q&A?
Yeah, I think that will be better, because the flow here otherwise
flow breaks down.
breaks.
So,
or maybe you can put
on
it in the chat, and then later on Nikita can help me, read out some of those questions and I can respond. Thank you. Other problems are incomplete financial statements, again, which is a challenge. During transaction audit also, we face a lot of challenges, which is unavailability of required information. There is no cooperation from the corporate debtor or the borrower. Records from the bankers do not come. There is a look back period, which is again an issue, because sometimes the look back period is only 2 years, which the RP wants us to cover. But there are no transactions in those 2 years, and whatever malpractices or things have happened prior to that. And that's why I said look at forensic audit rather than looking at transaction audit, because if you look section 66, which is also can qualify under avoidance transactions, does not have any look back periods. You can even go back in time for 6 years, 7 years, 8 years to look at section 66 transactions, which are fraudulent transactions. And then undisclosed related parties, connected parties is again a major challenge, and to find out some of these related parties also become a challenge. After transaction audit, getting management response, delay in audit reports because of non-cooperation, collection of adequate evidences for court proceedings, and then misclassification. All of these become your challenges. Now let's look at some of the mitigating measures that you as an RP should take to tackle with these challenges. One, I already said, you need to prioritize forensic audit as an activity under your entire responsibility as an RP. You need to initiate the assessment at an early stage. When I say assessment, that is whether in this particular case you would need to do a forensic audit or not. And which is where I will connect back to what I said in the earlier slides of assessing the nature of the borrower, whether there is a willingness issue or there is an ability issue. If you see a willingness issue, you should definitely do an assessment that you need to do a forensic audit, and then start the process of appointment as soon as possible. Compile the financial statements, and you need to ensure that you secure all the evidences, all the documents, all the assets as soon as possible in the responsibility of an RP. So for example, if there is a server, immediately take a backup of the server, or remove all authority to previous people which are not required anymore to access the server, right? Just an example. If possible, take a backup of the server and keep, right? Take all the documentation that is available and put them into a secure place so that they are not destroyed. All the previous files, documentation, supporting documentation, etc. Take hold of previous financial statements or incomplete financial statements and take them to completion as soon as possible. Now, during transaction audit also, you need to put in certain mitigation measures, and most of it is put by people like us who are forensic auditors. So wherever there is non-availability of information, you have to look for alternate procedures that can be performed, like public domain information, bank statements from the bankers, or bank statements. If bank statements are not available, review of bank book, computer forensic can be performed, etc., etc. Right, and then also consider a reasonable period of audit timelines instead of 2 years. After transaction audit, there are issues like one of the gentlemen asked the question about why are not many of the transactions which have been submitted to the adjudicating authority getting passed. So you need to have a strong legal process in place where all the transactions which are identified by people like us who are forensic auditors are vetted by a legal counsel, The legal counsel, along with forensic auditor, works to ensure that all these transactions are well supported, well documented, and well represented in the court of law. A lot of times I've seen that is missing, and because of which the case submitted to an adjudicating authority itself is weak for them to take a action or come to a consensus. Next slide, please. We'll cover some of the issues that we can look at when it comes to transaction audit. When I say issues, that means when you are looking into the books of the borrower, what kind of things that you have to look at as red flags. First and foremost, in my experience, I have seen most of the borrowers have a very complex web of entities, either as customers or vendors or business partners or related parties, subsidiaries, foreign subsidiaries, branch offices, etc., etc. There is a very, very complex web of entities, and there are multiple transactions, either in the nature of operational loans, advances, etc., which are either declared or undeclared as related parties. There are shell entities with no real business. So you need to identify that all the main entities that the company was dealing with, are any of them shell entities? And there is a list of shell entities available, right, which you can use very well. If the entities do not fall into the list, there are certain steps basically which you need to perform to verify whether it is a shell entity or not. And I will come with some of the examples in the next slides when we look at case studies. Other companies that are floated by promoters in the names of their relatives, friends, employees, drivers, etc., and any operating transactions with tax haven countries or geographies. The second red flag is a very, very poor ERP system. Whether the system itself is poor or was poorly managed, both are red flags. And a lot of times you will hear that there was a fire or there was a flood, and the following system is missing, or the following system crashed, documents prior to this period are not available, etc., etc. All of these are red flags. Inflation of revenue and assets in financials and submissions to the banks are again red flags. I'll give you an example. One basic thing we can check is all the debtor statements or inventory statements that have been submitted to the bank. If you compare them back with the financials, and if they do not match, you directly know you are dealing with a borrower who has fooled the lenders by submitting fictitious or forged statements of claim to the bank, right? And then undisclosed bank accounts used for routing of funds. If you find any of the bank accounts which is not there in the books of accounts, there is a problem. Now, this is an illustrative modus operandi of few things that we saw. In this case, the consortium disbursed the funds to a particular borrower, and then the borrower opens 3 different companies, which is company A, company B, company C. Most of all these companies have directors who are some of their ex-employees or current employees or driver or other peons, etc. They have been shown as debtors or creditors in the books of accounts, so they are shown as customers or suppliers in the books, and most of the money that has come to the borrower has been routed through these 3 companies, either as in the form of customer payments, customer receipts, advances to suppliers, or ICDs to related parties, etc., etc. Under some modus operandi, the money is moved into these accounts. There are adjustment entries which are made to set off certain old standing entries against the new standing entries. There are fake expenditures that are booked into the accounts later on. There are inflated or fake product routing being done, shown into the books, where there is no actual product movement, but only book entries are passed to adjust some of these or accommodate some of these actual monetary transactions. There are losses, inventory losses, or loss due to theft, or loss due to fire, loss due to flood, etc., being booked to after a few years for writing off or setting off all of these transactions, etc., etc. Now, after you identify all of this, it is important to then classify them, whether some of these funds were further diverted or siphoned off. that also needs to be identified. Let's look at some of the recommended procedures that one has to perform in a transaction audit. You know, something very basic is financial statement analysis, which you start with. So looking at 3-4 years of financial statements. This is the scope which forensic auditor will perform. So don't mistake me by understanding this is something which RPs have to do, but RPs have to determine the procedures that the forensic auditor has to perform, and that's why we are covering this. So you guys should ensure that when you are giving work to a forensic auditor, you ask him to perform all of these activities as part of your scope, RFP, or the scope that you draft for the forensic auditor. So financial statement analysis, and one of the important things that you need to understand is ratio analysis should be performed under financial statement analysis. You should ask the forensic auditor to perform ratio analysis and give you the results as part of the report. Review of money trail, that is, using the entire fund trail system to look at the utilization of the funds. Third step here is very important. Background check and market research should be performed on some of the key vendors and some of the key customers or business partners of your entity. And you should ask forensic auditor to perform this. Field visits should be performed. I'll tell you, for last 6, 7, 8 years, but all the time that we have been doing forensic auditors, we always perform field visits unless and until the RP is not paying for that or is not willing for us to do the same. Except for the 1 year in between during COVID times when there were restrictions to move out. Apart from that period, we have always done field visits because there are miraculous results you get when you visit some of these premises of your vendors and customers, right? You should perform certain analytics on data like bank book dump or your GL dump or PO dump, etc. Your payments data, because you identify a lot of red flags there in terms of duplicate payments, duplicate vendors. Vendor master is manipulated, customer master is manipulated. There's duplication between vendors and customers. There are employees in the books who have been shown as vendors or customers, so on and so forth. There are a lot of things that you identify when you ask your forensic auditor to perform forensic data analytics. Let's move ahead, Nikita. Financial review of books and records, I think we already saw. I would want to focus here on certain things, and which is why I'm not going into details of others. Digital forensic. Now, this is again very important. And I have seen most of the forensic audits do not cover digital forensic. And another point which I just said, in the previous slide, where I asked, as an RP, as soon as you get authority or you get custody of the office, first thing you should do is you should safeguard the assets of the company. And when I say assets, most importantly, IT assets, where a lot of information and data is stored. Because all this information and data is the only oil for you to run the company as a process of IBC. If you do not move quickly and take custody of these IT environment or the IT assets, either lock them, secure them, or take a backup of it, it will be destroyed or it will be lost in the long term, which is what we have seen mostly in our forensic audits. So take that custody. Second step here, if by basic books and records audit of, for a forensic audit, if you are not getting desired results, please extend your forensic audit, give them access to this entire server data, which includes emails and communication and other backup of, the data from the laptop of employees and promoters, and ask them to review that, because there is a whole lot of information and evidences that you get out of this data. You find email exchanges between promoters, between parties, where they are discussing clearly on financial transactions which are completely non-related to the borrower's operations, and a lot of other modus operandi is discussed over emails. A lot of Excel sheets are maintained, a lot of Word document formats you can find. I'm telling you, this is a ocean of oil if you churn it, but unfortunately it is an expensive effort and it is a time consuming activity. and most of the RPs do not include this element in the forensic audit. Now, for forensic audits which we have done 3, 4, 5 years back, now when those cases are picked up by regulators like SFIO, CBI, etc., we have been asked this question directly: why have you not performed digital forensic? Unfortunately, we have to say it was not in our scope. We were not paid for it. But in some cases where we have covered this, and basis our suggestion, lenders and RPS agreed us to give this particular item in the scope of forensic audit, there are very good results which have come out. And today, when the cases are pursued legally, those are very, very effective as terms of evidence, in terms of evidence, because most of it is derived, which is compliant as per the Information Technology Act and the Evidence Act. And last but not the least, to perform certain investigative interviews, we need to sit back with the previous management to get and ask questions about some of the red flags that have come out. I have seen a lot of times the forensic audit is closed without even discussing with the previous management. And once you take the report to the court or file it to in the adjudicating authority, the management comes back and starts questioning the observations and findings and data which is submitted as part of the forensic audit. And then that unnecessarily delays the process and so on and so forth. This here I've just covered more information for all of you. When these slides are circulated to all of you, you may go through it. But this basically covers some information sources. Some of them are paid, some of them are even free. And I have highlighted the ones which are subscription based and some which are open source information. And these are over and above the regular Google searches. So in case you want to do your own homework as an RP before you give a case to the forensic auditor, some of these public sources information may be very helpful to you for doing your own internal homework or assessment. This is again a slide on forensic technology, which I was talking about, digital forensic, very, very important and very effective in forensic, in the world of forensic. How is it performed? So basically, all the documents are taken as backup or a forensic image from the from the IT environment of the company, and sometimes the data is in terabytes, huge data. Now that data is then extracted in the form that it becomes reviewable for forensic auditors or forensic professionals. Sometimes you have to do your optical character recognition, which is OCR, or you have to extract the information and then put it, format it, clean it, do all of that. And then we do something which is called as indexing. By indexing, what you do is you remove duplicate items and you arrange all the files that have been taken from the IT environment in a manner that they become reviewable for anybody who is going to review the documents. Then we do perform certain graphs, analytics, etc., which give us red flags. And most of the red flags are in the nature of fake documents or email conversations or involvement of previous management, promoters, or you get a complete fund trail of how the money is moved from one person to another person to a third person. I'll give you an example. In one of the investigations we did, or forensic audits we did, we found an Excel sheet in the computer of the CFO, the previous CFO, which was like a icing on the cake for the forensic auditor and the RP. That Excel sheet was a manual tracking which the CFO used to keep with himself on all the money that has been disbursed to them and what is the actual utilization against each of the line items of the disbursement. How the money is moved from company A to company B to company C and then finally to company D. How that money has come back into the borrowing entity, either in form of capital or in form of customer receipts or in any other form. And then again, how it has been used. So entire routing of transaction or diversion or siphoning was very, very clearly depicted in that Excel sheet. And the Excel sheet was personally maintained by the CFO of the company on his laptop, which we found during the course of digital forensic. Now, this was bang on. That is what somebody was looking for when you do a forensic audit. So that is how important digital forensic as a procedure becomes when you do forensic audit. Let's move to the next slide. Yeah, so as I was saying, securing of evidence is very, very important. Analyzing it and then presenting it as evidence. So some of the sources of evidences that you should take care of, I have just mentioned a few of them. There can be many which you can't put on the slide, but some that the RP should be, more mindful of as soon as you take charge of the office. Bank statements, ERP data, financial statements, email server, all of it. You can read through it. There are some methods to secure it, but one principle in securing is earlier the better. I am again and again focusing on the topic of, as early as possible, secure the data. Right? You can use any of the methods, which is fine. You can create a backup. You can lock the data or remove access to data by others. Many ways to secure it, but earlier the better. And then presenting the evidence in the form of photocopies, forensic report, trends, linkages, etc. We can move to the next slide. Learning from our experience. Nikita, if you may allow, can I take a 2-minute quick break before we proceed to this section?
Sure.
I'll just be back in a minute.
I just request all the participants, if they have any questions, you can put it in the chat box.
Hi, Sanjana. Are you waiting for me to speak?
James, we are will start your session at 4:10 or 4:15 IST. So Vinay has yet to complete his session, and then we can.
Fine. So you don't need me right now?
No.
That's fine.
He has just taken a 1-minute break.
Sure, absolutely. That's fine.
Oh, okay. Thank you, James.
Hi, Vinay.
Yes, hi, I'm back. Can we start?
Yes, Vinay, we can.
Nikita, before moving to the practical example, should we take any questions which are there in the chat box as of now, so we keep covering them also?
Sure, Vinay. I'll just.
I can see one question from Aarti. If forensic audit reveals siphoning off of funds or diversion of funds by CD, then can authority order attachment of his personal assets and his family and relatives? Definitely, if you have adequate evidence through the forensic audit, and if your legal counsel is confident that the evidences are robust, that the funds have been diverted to create these assets or siphoned off otherwise by the previous promoters, and there are properties which have been created in the names of the relatives, the adjudicating authority can attach personal assets. And precisely for this reason, one other activity which is performed in a lot of times is asset tracing. Apart from forensic audit, there is a specific activity performed on tracing of assets of all the promoters or the previous management, and which is where assets in the name of the relatives and some other closed circle group of the promoters are also identified. The source of the funds for creation of those assets are tried to be traced back, or the adjudicating authority asks the promoters in a lot of cases to prove that the sources are from clean sources, and then the assets can be attached. It can also be attached in the formal process of the legal regulatory process of ED or CBI during their investigation.
Yeah, thank you, sir. Sir, any relevant cases also there on this regard?
There are a few,
uh,
yes, attaching of personal assets. There are a few examples. I'm sure you must be aware about the famous case on Kingfisher Airlines and Mehul Choksi, etc.
Yes.
So there are some cases which are very famous, but there are some cases which are not so much in public domain. But if you do some research, you will find out there are many cases on attaching personal assets of the previous promoters.
There should be very strong evidence, no, that
Yeah, there has to be
been
strong. There has to be
funds have been diverted towards the
correct.
making of the assets, personal assets.
Correct.
Okay,
There
right,
are
sir.
also
Thank you.
cases where basis circumstantial evidence, but very strong circumstantial evidence, the authorities have asked the promoters to prove that the source of funds was clean source for creation of these assets.
Okay, right, sir. Thank you.
Hello.
Yes, please.
Yeah, Vinay. So one of the participants asked the question that the reliance over the system in functioning of the companies is increasing day by day. So what practices can be adopted by the insolvency professional to cope up with the changing technology?
I think attending more of these kind of sessions is the only way that you have to keep yourself updated about the changing technology. But if you take charge of a company which, where you see a lot of technology being put in place, which you do not understand, I think it's best to take help of, competent people, who are maybe professionals, outside professionals, to understand them. But, it's not a challenge only by an IRP to keep cope up with the changing technology. It's, I think in today's generation, it's a continuous challenge for all professionals like us to keep ourselves updated on the changing technology. But I think just keep yourself updated by reading and by attending more of knowledge sharing sessions. And wherever specific case to case basis, take help of relevant professionals.
Thank you, Vinay. There's one more question. How much help do you get from a statutory auditor of the company, and any advice you have? for collation of data from the auditors?
Hardly any help you get. There are in most of the forensic audits we perform, we do write to the statutory auditor to submit all the documents that they have gathered during the course of their audits in the previous years, and also sometimes prepare a detailed list of questions and queries and send it to the statutory auditors on what is their opinion about these transactions and why these transactions were put in place and were they identified as part of statutory auditors, and how how did they satisfy themselves on these transactions. But hardly you get a response, hardly. So technically you get no help from previous statutory auditors. In fact, in a lot of cases, I should not be saying this in an open forum, but without taking names, in a lot of forensic audits, we find that the statutory auditors themselves were working hand in hand with the previous management to structure some of the transactions for routing of funds and siphoning off of funds.
Thank you, Vinay. I think so we can move
Okay.
to our session. Yeah.
So I think most of the important elements and few points that I had to emphasize on, I have made. Let's look at some of the practical examples. Now, this is what I covered earlier in short form, that you need to ask forensic auditors to perform ratio analysis when they do financial statement analysis. And sometimes you get very good red flags and understanding when you perform these ratios. This is something which you can read when you get the slides. I will cover these in the form of certain charts or graphs that are there in subsequent slides, so we can move ahead. Next slide, please. Nikita, you can come to a slide where there are some graphs. Yeah, we'll come to this again, but move ahead. Yeah, so if you look at this, this is an analysis of accounts payable and accounts receivable movement for 3 years, 17, 18, and 19. And if you see how substantially the numbers have moved, loan from the banks have doubled in 3 years. That is from 500 crore to it has crossed 1,000 crore. Payable to suppliers have reduced from 800 crores to only 97 crores, right? And receivables have increased from 200 crores to 1,000 crores. And accordingly, obviously, the receivable collection days has also increased. Now, this clearly shows that a lot of payments have been made to suppliers who were related parties, and that is being used as a modus operandi to take money out of the company. A lot of these customers whose receivables are outstanding for more than 600 days, potentially were shell companies or non-operating customers or fake customers on the books. Now, a simple graph like this will give you this analysis immediately. Next slide. This is what I was saying, when you do field visits, this is what you find. So some of these images that you see are addresses of the directors or in the companies with whom company had hundreds of crores of transactions in the form of either purchase or sales as a supplier or as a customer. And when you did further verification, most of these people ended up to be the drivers or peons or office staff. So simple thing, what forensic auditors have to do is just visit some of these addresses, do inquire from some of the neighborhood on who is this person and what is his name and what is his family and what does he do, etc. Similarly, we spoke about performing a detailed public domain search or background verification or market research. And when you do this nowadays, the sources are plenty. One of the very, very important sources, social media. People who are spending lavishly cannot stop themselves for putting their pictures of some of these exotic things that they do on social media. You need to find these out, link them date wise, and then link these events and activities with the events and activities and financial performance of the company and the borrowed money. Sometimes a lot of these destinations and places are also traced back with the places of customer payment, or sorry, vendor payments or investments that they have shown in the books, and you end up seeing that a lot of money is going into Dubai, and then when you do some more research, you see that the promoter has an alternate business in Dubai which is run by his daughter, or he visits Dubai very frequently, and when you do further research, you identify that he has created an asset in Dubai, because most of these payments which were made to Dubai do not have any supporting documentation in terms of supplies or product details or deliverables, etc. Right. Now, in this case, also you see, the daughter of the borrower posted this picture, and it also had a caption under the picture that this is a lovely gift from my dad on my birthday, which is a Rolls Royce. And the picture was, posted on the social media along with a very big celebrity in, outside of India. And then when you link back these posts, you see that sometimes these kind of photographs are after the company been admitted as NPA, or sometimes these photographs link back to the exact period of disbursement and then a subsequent transfer to a particular country or a geography where you will then link back saying that the daughter or the family lives. So I'm just giving you very, obviously I can't share more facts in terms of, the names and details here, but these kind of linkage analysis we have to do in terms of place, geography, time, event, and these activities. We can move next. Yeah. Now, financial transactions, what we do, obviously we look at sales and receivables data. We look at any kind of round tripping that can be identified. We look at expenses which look out of normal, and then you look into details of inventory. What out of these 4 or 5 things, which ones you focus more, all depends upon case to case basis. After doing a basic financial statement analysis, you identify which is the area which needs to be deep dived into. For example, if there is a recent transaction of writing off of old inventory, you need to get into the details of inventory, whether this inventory actually existed. Is there sufficient evidence that all the material which was procured or everything which was shown as finished goods in the books, are there supporting documentation to see that they ever existed before they were written off today? Right? If you see abnormal expenses in terms of professional or consultancy or commission expense, or a particular high value expense towards an activity like license or a sole supplier or something like that, you have to get into the details of that particular line item to see what is it about. Round tripping, I think all of you know, if you see a lot of transactions with shell entities, you need to keep going through the rounds to identify what kind of round tripping and how much of it has happened. Right? And sales and receives and collect, we already covered how the receivables day go up if you have related party transactions or you have transactions with fake customers on your books. Right. If you see anything on the slide which interests you and where you need me to share more, because these are very detailed, on each case study, if I talk entirely, I'll need 15-20 minutes to cover one slide. That's why I'm going a little fast, just covering some of the basics. But anything more that you see on the slide you want me to add, please mention it on the chat box and we will cover it, come back to it later and cover it. Yeah, I think this one is interesting. Come back to that table. Right, I was talking about the the inventory, and here we did analysis of 4 years of inventory revenue and inventory as a percentage of revenue. Now, if you see, the inventory has come down actually from 409 to 128, but the revenue has reduced from 578 to 38. And as a percentage between inventory and revenue, it was 71%, went up to 100, and then crossed 337%. Now, how is it possible? How can you have an inventory which is 4 times, which is your 4 years revenue basically? That means the inventory, whatever inventory is being shown, is also fictitious inventory. Now, this was identified as red flag, and when we deep dive, what did we find? The company was in the business of electricity transmission lines. Inventory held percentage of turnover. And then we saw company had inflated its revenue over the years to enhance facilities from the bankers. Fictitious purchases were made with increased inventory value. So the amounts in the procurement were inflated, and accordingly, obviously, the inventory value got inflated. And the physical verification could not confirm existence of inventory, resulting in a huge write-off in the P&L. So whatever 128 you see here, after the forensic audit and after the physical verification was performed, this entire amount had to be written off. Here I close the session. Some key takeaways. Plan well, as I have been saying from the first slide. Take help of technology wherever possible, because everything cannot be done manually even by the forensic auditor. Involve forensic professionals in the correct time and give them a right scope of work so that they can do justice to the job. And you need to be actively involved in the transaction audit. I have also seen a lot of times RPs do not take interest in the forensic audit once the mandate is given. They just say, you do it and give us the report, that's all, finish it. But they don't talk to the forensic auditor. They don't give adequate background or support to the forensic auditors, in which case, even the hands of forensic auditors are tied. They can't do much then without the support of the RP. Be a little skeptical. I would say you need to maintain a good balance between the two, because if you are skeptical always as a role of the RP, you will face challenges of performing your duties. But you need to be a little skeptical whenever you see red flags which we have covered above. For example, non-cooperation, you should be skeptical. ERP system is poorly managed, you need to be a little more skeptical, etc. And timely assessment and action, I think, is very, very important. I think here I rest the presentation, and maybe we can do the Q&A now or after James' session. I don't know, Nikita, what's the plan?
Maybe, sir, for 5 to 10 minutes, we can have the Q&A session, and then we can move to Lord James.
Perfect. So I'm just going through the chat to see.
The participants can also unmute themselves if they have any questions.
As far as sharing of the PPT is concerned, somebody has asked a question.
Sir, I have a question. Do the IPs should also evaluate or explore approaching concerned authorities like CBI and ED, because if there are strong evidence in front of him or her that there has been a diversion of fund or manipulation or fraudulent transaction like transfer of properties, entering of fake bills and all, which can only be investigated by certain investigation agencies. So if we wait for outcome of the audit report and all those things, naturally auditor also has certain limitation, whereas investigation authorities have very wide scope and they can use different means to unearth the truth and uncover the transactions. So what is the guidance on this? Should we, because what I have understood while interacting with various IPs, people are reluctant to approach the concerned authorities. They say that, why you get into all these things, the assignment will be over within 6 months or 1 year, and you will be unnecessarily involved in all these things. So what is the practical approach and what is the correct way of performing the responsibility as an IP, sir?
I would suggest, see, as far as technical answer to this is concerned, as an RP and as a authority in itself, being an RP, nobody can stop you from approaching the regulators if you find a wrongdoing. Even as a common man or a citizen of the country, you can approach regulators. It is so open. But from a practical point of view, I have not seen RPs directly approaching CBI or SFIO or ED. It is always done through the lenders, because the responsibility has been put on the head of the lenders to report to the regulatory authority. As far as RP is concerned, you can only make your submissions to the adjudicating authority, and then later on it may be ordered for a investigation by CBI or ED accordingly. That is practically what I have seen. But the question also has certain legal elements to it, and I'm not a lawyer, so maybe another practicing lawyer can also give you his opinion and technical answer to it. But as far as allowability is concerned, I don't see any restriction. You can do it, but practically we have not seen RPs directly going to regulators.
Sir, there is one
Thank you, sir.
That what are the key steps that can be followed by IPs to determine the suspicious transactions?
To identify
suspicious transactions.
So we covered a lot of red flags during the presentation, which you need to be mindful of or watchful of. As soon as there are different categories. One, as soon as you get into the role of an RP, there are certain red flags that you have to look for, which we covered in some of the early slides, which is something like an mismanaged ERP system, an incident of fire which has happened recently, a large write-off that you see on the books, non-cooperating promoters, etc., etc. These are some of your initial red flags to get a sense of what are the kind of people that you're dealing with and what are the areas that you need to focus your attention as an RP. And then we covered certain specific red flags in terms of ratio analysis, or looking at sales purchase transactions, looking at transactions with shell entities if there are any, perform background verification of some of the high value customers and vendors to identify red flags. All of these put together will give you a bundle of fishious transactions. And if as an RP, if you're not comfortable or if you do not have bandwidth to get into it, anyways, these activities will be performed by forensic auditor. So you can do an early assessment whether you need a forensic audit or not. And if you have a strong intuition that the borrower that you're dealing with or the company that is now you are RP of has potential of forensic transactions or fishious transactions, I would say do not wait until a later date to start your forensic audit activity. I work with few RPs. I will tell you, they are so proactive in getting forensic audit done. As soon as they are appointed as an RP of a particular company, he shares information to basically assess whether forensic audit is required, and then immediately rolls out the RFP to get the forensic audit started.
Okay, so there is one more question. The person is asking that can the RP differ with the findings of the forensic auditor and file a case with NCL?
Definitely he can. As per IBC, but the law doesn't put the responsibility of identifying fraudulent transactions on forensic auditor's head. RP is only taking help of the forensic auditor to perform this activity. RP is the final authority to go to adjudicating authority. So if the RP feels that there are transactions which forensic auditor has missed out to report in his report, RP can independently go to the adjudicating authority and file those transactions. Or if RP feels otherwise, that certain transactions which the forensic auditor has highlighted as fishious transactions or fraudulent transactions, but RP does not believe them to be so, he can definitely create his own internal paperwork on why he does not feel these transactions need to be reported, and then do not report the same. So the final authority here on taking a call whether transactions have to be reported or not to the authority is of RP, not of forensic auditor. But he needs to maintain adequate documentation for his own safeguard tomorrow, because tomorrow he may be questioned that if this was, all these were mentioned in the forensic audit report, why didn't you file them in the to the tribunal? So he needs to have adequate explanation and documentation to show that he has taken cognizance of the report, he has done his internal deliberation, his internal homework, and then why has he come to a conclusion whether this is to be reported or not.
Thank you. Sir, one of the IPs is asking what triggers an IP to go for forensic audit. I think he may be asking like what is the difference between transaction audit and forensic audit? Whether we should go for transaction audit or forensic audit in any of the case.
I would suggest you should always go for a forensic audit which includes transaction audit, because in forensic audit you cover a larger period like 5, 6, 7 years, and in the same mandate you can tell forensic auditor to cover transaction audit clauses also in terms of avoidance transactions. That would be my suggestion, and that also gives the forensic auditor more open hand to look at things and identify stuff. And you can definitely tell the forensic auditor that in the report that he submits, he can clearly outline which are some of the forensic transactions which do not form part of avoidance transactions, and what are the transactions which the forensic auditor is comfortable to suggest to the RP to put them as avoidance transactions. So that kind of a active dialogue between the forensic auditor and the transaction and the RP can help him determine what should be done or how he should proceed with.
Thank you, Vinay, for the insightful and detailed session. I would request now Honorable James Pickering for his judicial review and remarks and what he thinks about how the antecedent transaction application should be dealt.
Thank you. One point, somebody has asked a question on sharing of the PPT. Most of the slides in the PPT can be shared. I will just work it internally with Nikita and Achal and everybody to delete some of the photographs, etc., which we use only for the sessions, but are non-circulable. So once we just sanitize all that stuff, everything else can be shared.
Sure, Vinay. Thank you.
Thank you so much. All the best, James.
Thank you, Vinay. It was indeed a very interesting and useful talk. Well, thank you for all of you attending today. I'm speaking to you from a rather grey London, but no surprises there. I've been asked to speak about antecedent transactions, but from the judicial perspective, and in particular, the judicial perspective from England, where I sit as a judge. And although the technical details will be slightly different, the broad principles will, of course, be very similar. In terms of antecedent transactions, it's very much a statute-based regime. And therefore, for a judge, the starting point is, quite obviously, we have to follow and apply statute, and we do so in accordance with the guidelines in any relevant case law. Having said that, I think it's always important, whether you're a judge or whether you're a practitioner bringing a case or defending a case, to bear in mind what I consider to be the two key principles which really permeate through all of antecedent transaction and disputes. And these two principles, they're actually a bit of a tension with each other. They're sort of competing, so it requires very much a balancing exercise for the advocate and for the judge. So what are these two competing principles? Well, the first is pretty obvious. It's the underlying policy should be to promote confidence in the system, to promote confidence for the investors. It's important for those who set up, our parliamentarians, our politicians who set up the system. It's very important that we have a system where investors are confident that there isn't abuse. The investors, it may be banks, it often is banks, but it could be any private investor from or state investment or whatever. If directors are seen to be able to get away with transactions which are questionable, people will lose faith in the system. So banks will be less inclined to lend money or to invest, investors will be less inclined. So it's quite important we have a system where if someone has committed a corporate wrong, and I use that in a general sense, people can be confident that it will be treated in an appropriate way, and the abuser will not be allowed to get away with his or her abuse. So one principle very much is we need to have a system which is a deterrent and which will clamp down on directors or other people involved in companies who abuse and commit some form of corporate wrong. The other slightly competing principle is that there must be, we don't want to thwart or prevent entrepreneurism. In the UK and in India, we both have a history and culture of being entrepreneurs. And that is something we don't want to lose. We want people to go out there. We want people to create new products, to create new businesses. We want people, and businessmen sometimes have to take risks. In fact, the best business people do take risks. So if you have a system which is too strict and too restrictive, it will deter entrepreneurs, it will deter people. So we have these competing things. On the one hand, we need a system in terms of antecedent transactions, which is sufficiently robust and strict, so people can't get away with it, so that the banks and investors have confidence. On the other hand, we need to make sure the system isn't so restrictive and so strict that entrepreneurs will say, well, I simply can't do this, I can't take these risks. And that is not necessarily good for those economies like those in the UK and India. We want to expand. So risk-taking, yes, but not, you mustn't overstep the mark. Now, it's fairly easy for me to say those principles. It's another matter being able to put those into practice. But I think certainly in the English statutes, we do see that reflected in the statutes and therefore in the case law. And to give you some specific examples, I just want to briefly cover 4 different types of antecedent transactions, which are pretty common certainly in the High Court in London. The first is transactions at an undervalue. This appears for what it's worth in section 238 of the Insolvency Act in 1986. And pretty much it is what it says, a transaction at an undervalue. If a company wishes to give away an asset for nothing, or it wishes to give away an asset at a very low price, maybe there's a property worth £5 million and it transfers it for £1 million only, generally that's a matter for it. But if the company soon after goes into an insolvency process, then that's a different matter. And that'll be the job for the insolvency professional. So it'll be in England, the liquidator, in India, the RP, to try and look at these transactions. And if within a certain period of time, and in England it's normally 2 years for these sort of transactions, if it appears that the company has given away assets either for nothing or at a significantly lower consideration than true value, and it did so within this 2-year period at a time when the company was insolvent or became insolvent, then the starting position is the liquidator can recover the transaction. Now, often we'll find that these transactions are made with connected companies. So a director of a company, he or she can tell the company is shortly going to go bust and has a prize asset, maybe a property, and decides to transfer that property to another company under his or her control. But instead of doing it for the true value, it's given away or for a much lower valuation. In that situation, the liquidator can come back in and recover the property. But under section 238 of the Insolvency Act, we have this provision that it is a defence if it can be shown that the transaction was carried out in good faith for the purposes of carrying on the business of the company, and it was in the best interests of the company. There's a real difference between sort of situation where I've described, where a director is just transferring assets cheaply to a company which he or she or a friend, his husband or wife, controls. That's an abuse. But if it was done in good faith, and the businessman thought, well, I need to transfer this property quickly to try and get some capital, to money to save the business, and I sold the property. Yes, it was below the true value, but we needed some money quickly, and that was the best that we could do. If that was a genuine good faith decision, then that shouldn't be punished in this way. So there's one thing for a director or someone in control of a company to abuse the position, and another if it's a genuine attempt in good faith. Now, I give them fairly polarized examples, which are fairly obvious where the line should be drawn. But you can imagine there are plenty of situations on the spectrum where it's far less clear cut, it's far more grey. So that's the first area, transactions and undervalue. The second is preferences. It's under section 239 of the Insolvency Act. And again, it's fairly obvious what a preference is from the title, but sometimes there may be a genuine debt and a company is about to go bust, and the company genuinely does owe money to various companies and individuals. It may be that money is owed to a director, and the director chooses, rather than to pay off the trade creditors, decides to pay off him or herself, or to pay off a connected company in which he or she has an interest. Or maybe it is to pay off a bank, but it's a bank where he or she has a personal guarantee. Now, that's a preference. And here in England, the key wording is there has to be this transaction, has to be within a certain period. Here it can be either 2 years or 5 years, depending on the situation. But here, it's only actionable. You can only sue someone if that transaction is brought about by, and this is the wording, a desire to prefer, a desire to bring about this position. So if someone in the course of running the business decides, I'm going to pay off this connected company, yes, I have an interest, but it's a genuine business decision, that's fine. But if the director, he or she, can see that the company is going under and makes that payment to himself or the connected company because they know there'll not be enough money left and they want to get paid off first, that's a clear preference. So again, there are clear situations at the extremes, but in the middle, there's this grey area of cases. Sometimes it's not so clear cut. The third area is transactions defrauding creditors under section 423 of the Insolvency Act. And these are transactions, it's a bit like transactions of an undervalue, but where someone puts assets that they sell them off cheaply, either they give them away or significantly below the true value. But this is not necessarily an insolvency situation, although often it's a case which will be brought by the insolvency professionals. Here, the test is whether the transaction was done for the purpose of putting assets beyond creditors, for the purpose of prejudicing creditors. So again, sometimes there are very good reasons why a business will give away an asset or will sell off an asset for less than its true value. Sometimes there may be very genuine reasons for doing so. If, however, the desire is to, the purpose is to defeat a creditor which you have in mind, or maybe just a creditor which you think you may have in the future, that's a different matter. So again, it's testing the purpose. We don't want to thwart entrepreneurs, but we do want to stop abuse and therefore encourage investor confidence. So again, we have this tension. Some cases are clear cut, but many will be in the middle. The fourth and final area of antecedent transactions I wish to cover is wrongful trading. Now, this is when a company, it does go bust, and the insolvency professional comes in and thinks, well, surely it was obvious they were going to go bust a year before they did go bust. The director should have stopped the business. And instead, the director continued the business for another year when it should have been very obvious the company was going to go under. Now that's wrongful trading, and the director can be sued for the additional losses which have been caused by any period after it was obvious the company should have gone to liquidation. But again, there is a carve-out clause. There will be no case if the decision made was genuinely in the best interest of the company and the director had a reasonable belief that to carry on business might result in the company being saved. So again, you get plenty of situations where a director can see it's very likely the company will go bust, but rather than putting the company liquidation, he or she continues the business because they want to milk the company. They rack up more debts, they get it more credit, they get more assets in from trade creditors who they have no intention of paying, and they bring in as much money and then basically asset strip the company for their own benefits. That's a clear case of abuse. At the other extreme, there may be a director who genuinely thinks that with a bit of luck and with certain transactions, they can turn the business around. Rather than falling on the sword too quickly, they genuinely believe that they might be able to save the company. In fact, they're wrong, and despite their best efforts, the company does go under. Now, again, that's the other extreme. So just to bring this to a conclusion, all of these provisions for antecedent transactions, yes, it's obvious there needs to be a certain robustness because we want to make sure that directors who abuse the system do not get away with it. There must be a sufficient deterrent to prevent directors trying to do these things, and there must be sufficient confidence so that banks and other investors know that there's a robust system, and where a director, he or she, does cross the line, they will be sued and attempts were made to recover those monies. So it's very important we have that robust system. But on the other hand, that we need to have these carve-outs to make sure that in this robust system, we don't catch genuine business people who generally are entrepreneurs and want to take risks and haven't crossed the line, but have nevertheless been caught up in insolvency. From a judicial perspective, we have these statutory carve-outs, and sometimes it's obvious that someone is abusing the system. Sometimes it's absolutely obvious that they are absolutely genuine. But again, usually the cases which get to court, which get to me as a judge, are on this spectrum, they're in the grey area. And it's for me to balance up the evidence and to form a view as to whether the transaction in question was a genuine and a good faith attempt to save the company, or whether it was simply misguided but an entrepreneurial step, or whether it was an abuse which ought to be subject to the sanction of the law. And that's a balancing exercise. And so it's always important from my perspective to have both of these things in my head, always by reference to the statute and the case law. So what are the takeaways? Well, for practitioners, whether you're a lawyer or an insolvency practitioner, you have to remember these competing interests. If you're the person bringing the case, normally the insolvency practitioner, the insolvency professional, what you need to impress upon the judge is that this wasn't just entrepreneurism. They crossed the line. This is something which was an abuse. And this is not something which can be easily explained away by someone simply taking good faith decision. This is someone who ought to face the sanction of the law. And for those of you who are defending directors or defending the recipients of these transactions, the idea is to impress upon the judge, always within the guidelines of the statute and the case law, to impress upon the judge, well, yes, it went wrong. We're in liquidation. That's why we're here. But not every liquidation involves an abuse. These were genuine good faith decisions. Genuine good faith decisions in a genuine attempt to save the company, a genuine attempt to make money to pay back creditors. It transpired, it didn't work. But sometimes in business, these risks are taken and they don't work. But it was made in good faith, and therefore I should not be subject to the sanction of the law. So those are the takeaways. Depending on which side of the argument you are on, I suggest that within the framework, you focus on those competing interests And for the judges, it's for us to weigh them up and consider ultimately within the statutory framework as to what decision should ultimately be made. Anyway, I hope that's just a brief overview of the judicial perspective, certainly from England and as to antecedent transactions. And like Vinay, I'd be very happy to take any questions or to hear any comments.
Thanks a lot, James, for the judicial review. We can now take up the questions. So I just request all the participants if they have to discuss or have any issues which they want to discuss, they can put it in chat or unmute themselves to speak.
I see a question here. The Indian insolvency ecosystem is facing a problem of low clawback ratio in relation to avoidance transactions. What practices can be adopted to improve such clawback? Well, I'm happy to answer that from the English law perspective. And I remember it was actually just over 3 years ago, it was just before COVID. I came to New Delhi and made a number of presentations with a number of insolvency professionals, lawyers, and RPs from India, particularly from New Delhi. And I remember thinking that one of the most useful tools which we have in England, which I understand is there in India, but to a smaller extent, is the powers which liquidators have, so insolvency professionals have under Section 236 of the English Insolvency Act. And basically, that's a power to, after liquidation, to examine and ask questions and request documents. Now, I understand there is a similar power to a certain extent in India, but the power in England goes further in that this power of a liquidator is not just against the directors and the people who may be the subject of being of a legal claim, but it's anyone who is able to shed light on the affairs or business or property of the company now in liquidation. That's pretty broad. So, for example, as a liquidator, and I often do it on behalf of the liquidator, we can write to them asking a director to give us information, or to produce documents, or to come in and to be examined in court. But we can also make those same requests from banks, from associated companies, from creditors. So when we're trying to determine, is there a case here? One thing we often want to do is to see the bank records. Now, of the bank records of the company itself, that's straightforward because the liquidator is entitled to get those bank records of the company itself as of right. But there may be other trade creditors, maybe customers or associated companies, and we want to see the bank statements, to see just the transfer of money, just to get them to really understand. This is where the forensic accountants will come in. But the power is, the liquidator will often use this. We can get bank statements, for example, or ledgers or accounts, not just from the company, the assets of right, but from other people. So imagine going to the bank of a customer, and there's a potential claim here for wrongful trading, for example. We can get this information, and the court will form a view as to whether it's going to be relevant. But if it does relate to the interests, affairs, or property of a company, the court will generally grant that. So the insolvency professionals, a liquidator, the RP, has great powers to get information and documents, not just the director, the potential person being sued, but from anyone else. And that, I think, is a great advantage here, and which is why I think we have a fairly good success rate in bringing home antecedent transaction cases, because we have a great deal of information, and therefore we can decide, actually, this isn't a case we think we should bring, or it is, and we have the evidence to back it up. So rather than having to go to court with limited evidence or to drop the case because we don't know, we actually can form a view and we have this evidence. So the short answer is, I think one solution is to use the existing powers in under the Indian system to get information, and maybe a systemic change is to broaden the powers so RPs have greater powers to get information from third parties. I'm not sure if anyone else has any views upon the powers that insolvency professionals have in either England or India.
Is there any comprehensive checklist to determine whether there is any this few transactions, preferential transaction, or is that the forensic audit is necessary to determine about that, or because in many cases here in India, the records are not available, and the company is a shell company like this. So what are the parameters to determine these preferential transactions?
Yeah, James, so just a follow-up question to that only. So, like, once the RP is able to determine the transaction, how he can support or what evidence he shall produce in front of the court of the law, so that he may have the quick decision making in this regard?
Yeah, well, as I say, in terms of the powers in England, it is not limited to the company, because the company itself, the company in the insolvency process, it may have very little records, it may be a shell company. But every case will turn on its own particular facts. But often it's a crucial tool to be able to go to someone who's dealt with a company and effectively examine them, and to say, well, why did you make this transaction? Why did you receive this transaction at this price? Did you not think this was not in the best interest? You can ask all these questions and effectively have a rehearsal for going to court. And sometimes it will not involve a forensic accountant. It depends on the nature of the information. But sometimes the outcome is that you receive all these ledgers, or you receive from a bank lots of bank accounts. I've had many cases where we've been investigating fraud, and we have the bank records of our own company, but we are able to go to others who we think are involved in the fraud, and we can apply under Section 236 and get their bank statements, which can be very revealing. And then you will need a forensic accountant to trawl through. So it'll depend from case to case, and sometimes it will require a forensic accountant to analyze, sometimes not.
Thanks, James. Any other suggestions or key takeaways for insolvency practitioners in India, which you think would be required to expedite these transaction application, avoidance application, and get a very good clawback and recoveries for the creditors? I'm audible, James?
Hello, sorry, was there a question? I missed that.
So any last comments or suggestions you have for Indian insolvency practitioners with regards to increasing of recoveries and expedite these applications to dispose of, so that this could lead to better recoveries for the creditors?
Well, one process is the Section 236 and using the examination tools and the recovery information tools as much as possible. As I say, in my experience, we use these tools in, I would not say every case, but the vast majority of cases, we use our powers under Section 236. Well, this is with my barrister hat on. On behalf of the liquidator, we will carry these investigations to speed things up. I think that depends on the system itself. Certainly, in England, there was an overhaul of the system in 1999, so almost a quarter of a century ago, and there was a big push to speed up procedures, to simplify a certain extent of procedures. On the one hand, it's important to be thorough. On the other hand, if you're too thorough, it causes great delay. And so, again, it's competing interests. If you have the most thorough investigation in the world, but it takes 7 or 8 years, that's unjust in one sense. So time can be a serious enemy. So I think the answer is to take the steps quickly, but try and use a fairly streamlined process. But that's really a matter for the system, and to try to make sure that the courts will hear applications and hearings sooner rather than later. That's easy to say, but it takes very much. And as I say, there was a cultural change in 1999, and everyone was told you've got to make sure things happen reasonably quickly. You can't just sit on matters. I think maybe a similar sort of process, if it might have started in India already, but I think it's just to install in the judiciary and the professionals. You've got to get on with things, and you can't just sit on matters. In terms of actual concrete steps, I'm not sure if it can be done without a change at the top, which just simplifies the procedures to make sure that matters can be fine determined sooner rather than later.
Right, James. Thank you so much, James, for this insightful session. I'll just now hand it over to Nikita for the closing remarks. I hope there are no questions from the participants. Nikita, over to you.
Thank you, Sanjana. Sir, I have a question, like what are your views on the cross-border insolvency framework and how effective it is in UK?
Well, in terms of cross-border insolvency, it's very obviously a growing industry. There's always been cross-border trade, and businesses have always been cross-border, but there's been an exponential increase over the last 25 years or so. There are still domestic businesses, but so many businesses now are either global or certainly international. And so cross-border insolvency, rather than being something which crops up every now and then, on the contrary, it now seems to appear in most cases, because most businesses that go into insolvency will have some, if not significant, interests overseas. So it's absolutely vital that countries are open to that. In England, we have a recognition procedure, and more overseas insolvency processes are recognized. So if there is an insolvency, for example, in India or Singapore or Malaysia, but there are assets in the UK, the Indian or the Singapore insolvency professional will come to England and want to be recognised. And there are rules on this as to when he or she will or won't be recognised. But the general principle is as long as you require the rules, yes, we want to encourage that. If the insolvency person has been properly appointed and it's a process which we ought to recognise, and generally they will be, we want to do that. We want to assist. And similarly, we want to make sure that where there are UK insolvencies, the same assistance is received overseas. One backward step from the English perspective, certainly in my view, was Brexit, which is a backward step. There's a lot of, there was and remains a lot of trade between the UK and its former EU partners. And there's a special system which made life much easier for insolvencies within EU companies. Now that the UK is out of the EU, in my view, a mistake, but that's my personal view, undoubtedly from a legal perspective, it is much trickier in both directions. It's much trickier for example, a German IP to get recognised, or for a UK one to be recognised. It still happens, but it has to be done in a more traditional way, whereas before it was as of right, which was very effectively as of right. So it was very useful. I mean, so I'm a big fan of the existence of the cross-border insolvency world, and I'm a big fan of being able to facilitate insolvencies in other jurisdictions and reciprocity. And so the UK recognises overseas insolvencies and hopefully is recognised elsewhere. And I know from my trip to last but one trip to India, that significant work takes place in that way. There was a Jet Airways case I recall, and lots of cross-border insolvencies. And so, and from my understanding, India is very much alive to cross-border insolvency work, and rightly so. So the UK and India both, I think, have a common interest in encouraging and recognising cross-border insolvency.
Thank you, sir. So I think we may close the session now. So there are no questions left. So thank you so much for giving your valuable time and sparing your time for all of us, for giving such insightful information about how the judiciary functions in UK. And thank you so much for all the suggestions. And thank you, EY team, also for handling the session nicely. Thank you so much, participants.
Thank you. I would also like to thank IIIPI, ICSI, and British High Commission for organizing this session. Thank you so much. And to all the participants for attending the session. Thank you. Thank you, James.
Thank you very much, everyone.
And Vinay.